What's happening, everybody? This is the Flow Show. I'm your host, Sean McLaughlin. He's your other host, Steve Straza. Sorry for the late start. We had a little bit of technical difficulties, first on my side, then on our studio side, but we fixed it. We're here. Straza, how was your weekend, buddy?
My weekend was nice. It was quiet. Quiet. How was yours?
Quiet.
Yeah, I played some golf, hung out, went to a gay parade. That was fun. That was sick.
That does not sound quiet at all. There's nothing quiet about Pride parades.
We just stumbled into it, but it's Pride Month, so there's all sorts of festivities down here.
I mean, I lived in Chicago a long time, and the Pride Festival parades in Chicago were, I mean, the city shuts down. It gets crazy and it's loud. I mean, it's
Yep.
fun, but there's
Yep.
nothing quiet about that.
No, they had the block shut down. We were doing a little happy hour tour, stumbled into the Pride Parade. It was a blast. It was a good time. Golf
Very
yesterday.
nice. All right. So, for those of you who maybe stumbled upon this show for the first time, what we do here in the Flow Show is me and Straza kind of show you how we come up with options trade ideas. Straza hits me with some charts that he likes, some setups that he likes, and then we kind of look into the options and see if there's a play there. Some, more often than not, we find a play, but we don't always find a play. And you know what? The great thing about being independent traders like we are, and like many of you are, is that we don't have to swing. We don't have to step up to the plate and swing at bad pitches. We only take the trades we like, and if there's nothing good, we sit on our hands, and there's nothing wrong with that. So anyway, with that set up, Straza, talk to me. What's on your mind?
And I think as you get older as a trader, you enjoy those periods when you're sitting on your hands. Like I look forward to them now. I enjoy them more and more every cycle. Um,
I don't know. I have mixed feelings about that. On the one hand, yes, I agree with you. On the other hand, sometimes it's a weakness in my personality. It's like I feel like I need to be
Dancing.
doing something. Like I feel like I'm like am I being a slacker here? Am I not engaged enough? Like I doubt myself, but that's just a weakness in me. I'm not saying that's the truth.
You almost feel like you're not working.
Yeah, exactly.
All right, look, throw it up. This is from the hot corner today, Sean. We got to talk about it. Look no further than the very first line of this morning's hot corner table. Mr. Warren Buffett back at it again. Occidental Petroleum. This is not new news. Their stake is, their stake is close to $20 billion at this point. They own north of 30%, almost 40% of outstanding shares, depending on whether you include the preferreds or the warrants, if they're in the money, out of the money, yeah, right. But they own a huge position, and they keep buying, Sean, at the very same level. So check out this chart. This is really the one. This shows it. We had like an early filing, March of 2022, where they were in the 40s. But then most of the purchases since the original one, or the initial Form 4 filing, which you should see here, the very far left, they're all happening right around $60, right? It's by design. They are support in this stock, right? We could draw a multi-year top or multi-year range here, okay? And we call this the Buffett zone because Mr. Buffett has been supporting the stock for 2 years now. This is a little table showing you, when he's been buying with the details of those Form 4 purchases. And you can see the average price column here, high 50s, low 60s. Sean, why are we not selling puts in this name? The people want to know. The people want to know.
So, all right, we have done this trade, a similar trade, many times
Yeah.
at many of these points that you have circled on this chart.
I don't
We
remember.
have sold puts, and it's
Yeah,
been
how
a
did we do
great
that?
trade.
So that's
Sorry,
what we
what's
did. We did that last year. We sold puts at this level.
I mean, at or near this level, during dips, right? During dips,
Yep.
we sold puts, and we did it for two reasons. Number one, we're on the side of Buffett. We think he's support.
Yep.
The chart certainly bears it out. So we had every reason to believe that that support would hold. That's a good reason to sell puts. Number two, actually, there's three reasons. Number two, we were getting paid to do it. During most of those dips, not every dip, but the ones that we played for sure, we sold puts because the premiums and the puts were elevated. We were getting paid to do it. That's a good thing. Number three, the reason why we sold puts as opposed to, say, buying calls to express our bullish bet is that we didn't necessarily believe that Oxy was going to break out and scream higher here. In that situation, you'd want to have exposure for that kind of move. We were just making the bet that it wasn't going to go any lower. It was going to hold this level. It might bounce, it might go up, but all we needed it really to do was just hold the level. All right. That's why we did those trades, Straza.
So back
Now,
to the well. He loves it.
right. Now, I mentioned the key point there, number two, being that, and every time that we did sell puts, and it worked every time. Why did it work? Well, one of the reasons why it worked every time is that the options premium, the put premium that we were selling was elevated. The implied volatility was rising at the time we were selling it.
Yep.
But Gene, if you want to go to my chart right now, I've got the Oxy up, and you will see that while Oxy is off the lowest, if you look at the bottom right-hand side of my chart here, this blue line, while Oxy is off the lowest levels that we saw in implied volatility about 2 weeks ago, it's still at the lowest levels, give or take, for the entire year, right? This level, if I highlight it, if you kind of follow this line along, we're at the lowest levels implied volatility has been all year in Occidental. And so if I pull up the option chain here, if I look in July options, which is where I would typically sell if I was looking to sell premium and collect premium, I want to go to the not the current month, but the next month. In this case, the next month expiration is July.
Yeah.
I mean, the level we would probably want to sell is the 57 puts. And look at the premium we're getting, Stressa. I mean, best case, we get hit on the offer. We can sell them for 51 cents, which would be a stretch. 51 cents, that's less than 100 basis points of the value of the stock. Generally speaking, when I sell premium, I want to get 2 basis point or 200 basis points, 2% of the value of the stock. That's kind of like a sweet spot. I don't always get that, but I'd like to be close to that. But under one, no, thank you. You're taking on a lot of risk for very little premium. So Straza, I'm going to hit you with a surprise.
Bang.
I like Oxy.
Yeah.
I like buying it here. I just don't like doing it the way we've been doing it. I think this is an opportunity to buy some calls, which we haven't done. And I think if you look into I don't know, September expiration, and you look at maybe the 65 strike calls. I mean, if this thing follows the pattern, Gene, if you want to go back to Strazo's chart, you can. His chart shows it better. If you want to, if the pattern of the stock, if it finds support here like it has over and over and over again, it's likely going to make another run back up to about $70 a share, and maybe higher. But even if it just goes up to around 70, and we buy these 65 calls right now in September for $1.40, I mean, minimum case, we're sitting on 3x return on our money if these things get up to, if the stock gets up to $70. And if it finally breaks out, we're positioned for a big win, knowing that we got, the Warren Buffett seal of approval on a breakout. That's always a nice thing to have. So I like this Straza, but I think I want to play it differently this time. I think I would like to buy September 65 calls. What do you think?
Well, so we're making the bet that these are going to pay us even if we stay in this range, right? That's what you were just explaining. We don't need a break out of this range. We don't need 75, right? We don't need to take out the upper bounds, which I've shown here.
I mean, look, if I was just saying, if we get to 70, these things pays, but if we get to 75, we pay $1. You could pay $1.50, actually less than that, but let's just say $1.50 you pay for the 65 calls now. If we get to 75, those calls are worth at least $10 plus a little premium left in them. I mean, that's a really good return. And that's without a breakout, right? Imagine if we get the breakout, then it's, we're off to the races. And so, and let me just throw this final point at you.
Yeah.
Buying the 65 calls, let's say we pay $1.50 for them. That's our max risk. That's the most we can lose. Now, my best practice, especially lately, has been if I lose half of the value of the calls, I'll exit. So if I paid $1.50 for them, if they're trading now at 75 cents a few weeks later, I'll pull the trigger and get out. So I've lost 75 cents. Well, if we sell those puts, those July 57.5 puts that we collect 50 cents for, and if this thing breaks lower, if it, for whatever reason, breaks that level of support, we're sitting on, a potentially multi-dollar loss, $3, $4, $5 loss in the value of the puts. Yep. That's a lot bigger loss than we'd lose on the calls.
Right. No, I get that. I worry about Oxy from a vehicle standpoint. Like, I love making the bet that level continues to hold because Warren Buffett's going to keep supporting it. But here's Oxy relative to energy. This is Oxy versus XLE. Mind you, XLE has not been strong, right? So this is a low bar in terms of relative ratios. We're hitting the lowest level since early 2022. fresh 2-year lows.
This is Oxy versus XLE. It's
Yeah,
index.
Oxy's become a dog in the space. So
Well, that just adds further credence to my case. Why would you want to sell puts in this thing? It could get a lot worse a lot quickly or
because
very
I think
quickly.
Buffett's stepping in at 55, $60, and that's worked for 2 years now.
Well, okay, let me play devil's advocate just for a second.
Yeah.
This Buffett trade has worked, like you said, for 2 years. I
Yeah.
mean, at this point, it's no longer a secret. The whole street knows this is what's
I
going
agree.
on.
Yep. I agree.
Well,
You're right.
what if he stops buying? Then what happens?
Yeah, and they break it down. I'm
Right.
fully with you. All right.
So
Let's
I like playing it with the calls, defined risk. And if we do get the upside breakout, then we're sitting on a really nice gain. But we don't even need it to break out. Even if it gets back up to 65, between 65 and 70, these calls are paying us very nicely.
and
So
these are the July 19 what strike?
I was talking about buying in September, looking at the September 65s. You can get them for $1.45, maybe even a little less right now.
September
$1.40 if you're lucky, if you're patient.
65 strike calls. All right. I like it. Let's explore another name now. I like this energy theme.
Okay.
Looking for some energy exposure. Now, same exercise. Exxon relative to XLE. Now, this I like. Okay. We have some sort of a reversal here in the relative trend for Exxon. I like a big liquid vehicle right now. I think, this morning's news, another acquisition in the oil field bodes really well for this group. I think we want to continue to earn the direction that these ranges, like the one we just talked about in Oxy, do eventually resolve higher. I think I'd rather be in something that's been outperforming, all year, like Exxon. Let me just contrast this with the other two big boys in XLE. Here's Chevron relative to XLE. Nasty, right? Not a vehicle I'm interested in. And Oxy was similar, right? And here's ConocoPhillips relative to XLE. Nasty, right? This is not what we want. Back to Exxon. Notice how this one looks different. Okay, this is our vehicle. Now with Exxon, just drill in here. We have a similar range, just like the one in Oxy, right? I think this base eventually breaks out. We continue to see the leaders in energy resolve ranges like this to the upside, not the downside. Flip it to a candlestick real quick, and let's throw in the 14-period RSI. We're in a bullish momentum regime. We were recently oversold right back in April. Now we're kind of pulling back here a little bit, but look at momentum, not even close to oversold territory, even though price has been falling steadily since early April. Now, to the price chart, let me just show how garden variety.
Garden variety. There it is. Had that on my bingo card.
This is what you tend to see in corrective waves. We pull back 38%. In the most extreme cases, about 62%. You tend to see those Fibonacci retracement numbers come into play, right? We're there now, 38% retracement. Like I said, price has been falling steadily since early April. I think prices dig in here. I think you get confirmation at this VWAP. I don't know what implied vol looks like, but I like a long call strategy on Exxon too. I think we blast through 120, and if we give it enough time, we're really just jumping consolidation pattern breakout here, right? I think if we go out to like next year, Sean, go to like a 125 strike, 130-ish, let it dance a little bit, and we're just making the bet energy finally resolves this range. And Exxon remains.
What's that blue squiggly line you got there? Is that a anchored VWAP?
This is a 200-day down here below price. And then this is the anchored V from the year-to-date highs. And that comes in right around 117. I think
what would Brian Shannon say about buying this stock right now underneath that anchored VWAP?
Brian Shannon would want to see price above the anchored V, but he would also be probably more concerned in a 50-day and then a 5-day moving average. So the 50, a little sideways here. So yeah, he'd probably be waiting. And then what would the 5-day show us? Super tactical stuff.
Look, look at us channeling two people that we channel a lot. I got Brian Shannon saying no, he wouldn't like the anchor VWAP, and then we got Kirk French there in the chat saying I gotta see it. He's channeling JC.
Yeah, and look, they're both right. I think this is at least one that you want on your radar. I don't think it's crazy to try and jump a new leg higher in energy.
Nope. Nothing wrong with that. I think on this trade, I like it, but I think I'm with Kirk. I got to see it break above that for two reasons, Jason, or for Straza. Two reasons. Number one, it's currently in a downtrend, a short-term downtrend, right? I'd like to see it come back above the VWAP. Also, and this is unique to me perhaps, but I also already have a very highly correlated trade to this on right now. I've got those
I know.
extremely long-term leaps in XLE. Do you remember that trade? We're still
Yep.
in it.
Yep.
We're in what are we, January 26, I
Yeah, I
think?
know. I tried to get you interested in this one a few weeks back too, remember? The Exxon's been
Yep.
on my mind. The Exxon's been on
No,
my mind.
no, I don't hate it. I feel like I'm already in that trade. That's the thing.
Yeah,
So,
you
but if
are.
for those of you following along who are not in the long-term XLE trade like I am, I mean, if you agree with Straz's stance, I think Exxon could be a good trade here. The volatility is pretty, not dirt cheap, but cheap enough that if you want to keep it simple, you could buy calls.
Yep.
I don't hate it. You have my blessing to do that trade if you're not already in XLE like I am.
Listen, you're right. You get a higher probability here above 117 once we recapture that VWAP. But I think this is likely to be an excellent entry if you were looking to build into something even. You could even
Mhm.
accumulate and scale into a common stock position here, right? Because look at Sean, not only was it the 38% retracement from the October rally, or I'm sorry, the year-to-date rally, but it's coming into the VWAP off of those January lows too. So I just think this is a lovely place, this 113 zone in Exxon to gain exposure to energy. Do you want to try one more?
Let's try one more. What
All right.
else you got?
So tech's been getting really just kicked in the mouth for a couple weeks now, right? But we do see setups like, let me just clear these
I
charts up.
just sold a strangle in tech, the XLK ETF, by the way.
I like that. See, yeah. So here's ASML, right? So here's what we're seeing with a lot of stuff. You know this chart, right? Prior cycle highs becoming support here, breaking out. Here's CrowdStrike. Prior cycle highs here, becoming support right now, breaking
Shouldn't
out.
we be fading CrowdStrike? It just got added to the S&P 500.
Listen, listen. I think you can get long these setups, these breakouts, because these are multi-month ranges now. This is a 5-month range here, shown on a weekly right here, right? So that's a nice ramp higher, some sweet digestion, straight sideways, and now this is like new leg up. I think you can get long these breakouts, but another one that I like more, setup I like even more. This is ServiceNow. This one got killed with the software sell-off. Look at this candle. This was just
Yeah.
May 30th, right? Down 12%. That was a sympathy sell-off too. Just crazy. Right. So what do I like about this? Sweet shake, dude. Look at this shake.
Sweet shake.
This is
That's a technical term, folks. Sweet
yeah.
shake.
I mean, look, again, whoever said it in the chat, same thing here. Gotta see it. But we're right there. Like this could happen this afternoon. If this thing shimmies higher back above this, I don't know, 705 level. I don't know, Sean. What's the vol like? Would we be paying too all?
It's middle of the road, middle of the road. So, I mean, the stock's a high price stock anyway. So I would even if it was vol was cheap, I'd still probably play this with a spread, like a
Yep.
bull call spread. So that would be my first inclination here. Um, would you go longer term on this, like maybe to the end of the year?
Yeah. Yeah. I think
Yeah.
end of the year's a sweet spot.
And so the play, I mean, you're making the bet that this was a shakeout, and then we're going to reclaim 800 and shoot higher, right? Is that's what you're
Yeah.
thinking?
And also just like look at how this thing trades, right? If we go back to early 2023, we got a range and then we leg up and out of it into another range, right? And then we leg up and out of it. We were sideways in a range all year. The
Yep.
primary trend is undeniably higher in this one, right? Another
Well,
range. It's a
I'm
shake.
looking at the December options, and if I look at like say an 800 900 bull call spread, so that means I'm buying the 800 calls
Yeah.
and selling the 900 calls. You could get it for about $21, which gives you 5 to 1, right? Like if you win on this thing, or 4 to 1, excuse me. The most the spread could be worth is 100, right? If you paid $20 for it, let's just keep the math simple. You could earn 4 times your money, right? Not a terrible risk reward for a call spread, right? That's a good acceptable reward to risk potential. But $21 for one lot might be a little rich for some people. Totally get that. That means you're risking $2,100 on a one lot. Again, if you're trading $100,000 account, no problem, right? No problem at all. If you're trading anything smaller, you might want to look at maybe a skinnier spread. Maybe you do like the 800 calls and you sell the 850 calls. That would cost you $13 and maybe 13.50.
So there, the way
Um,
that changes though is your upside is capped $50 lower, correct?
right. Yes. The most that spread could be worth is 50. And if you paid $13 for it, the
That works.
math, yeah, sure, it could work. The reward to risk potential is bigger if you could do the wider spread, right? If you sell the 900s, but still high probability. Well, it's not a high probability trade, but it improves your odds doing the spread versus just buying the calls.
And what if this thing just trades back into this range, but like, dances around 800?
Then if you hold on to the spread all the way to the end, it's a zero,
Yeah.
right? Because the 800 calls, those are the calls you're long. Those will be worthless and nothing. So I mean, and we said this earlier in the show. If I were to trade this one, I would trade it, buying the spread and then watching it. And if it loses 50% of its value, I'm out. That's one of my new big rules that I instituted in the past 6 to 12 months.
I like
and it's
it.
for me, it's saving me a lot of money.
I like it, Sean. I like
Yeah.
it.
No,
Listen,
it's a good trade.
all of these setups that we discussed here today, you can wait for confirmation and increase your probability of winning. The same thing with Service Now. I like it here. I think you could probably jump it just looking at what its peers have been doing, right? At what similar chart patterns are looking like these days. But 738.50, once we reclaim that VWAP from the year-to-date highs, I like it a lot more.
Yeah.
Like I like Exxon VWAP more too.
All right. I'm keeping my eye on Service Now. This is a trade I may put on this week. I'm going to be patient with it. I think we can afford to be patient.
Okay.
I think for today, for me, with my money, I like the Oxy trade. I'm going to put that one on. The October 65s.
Yep. Back to the
The
Oxy
September.
trade.
I'm sorry, the September 65s, not October. September 65s in Oxy.
So
That's my trade.
let's revisit the Oxy trade quickly before we close this thing down. We had a question from a client, which I thought was pretty good. Let's talk it out right here. When Sean or JC say it was a bad trade, for context, go watch the morning show. I got scolded today for being a bad trade maker. Because you aren't getting paid. Would it have been a better trade if you bought an out of the money put to cap downside risk at a discount since vol is low? Now,
Yes.
he was actually talking about the Uber setup from like last week, but I don't think Oxy's any different.
The answer is yes. If you define the risk, then it's better. It's still not a great trade. You're still selling premium and you don't want to be selling premium in a low volatility environment. I would prefer selling a put spread versus just selling a naked put in this environment. I still wouldn't do either trade. And while we're on that point, I hope that answered that guy's question, but this is relative similar. In the chat here, we missed this when he asked it earlier. Ryan Heath asked about why not give this a risk reversal? Why not sell the puts and buy the calls? Again, same reason. We're not getting paid to sell the puts. I love risk reversals. Everyone who watches me and Straza and JC knows that we love risk reversals when the environment is right. But right now, you're not getting paid to do it, and it's it's sure it can work. And what Straz was talking about the resulting. We kind of had a little argument on the show this morning. Straz is saying, hey, why don't we sell puts here in Oxy? It has worked. It'll continue the work, and this will probably work. And he's probably right. That trade will probably, the odds are in his favor that he will make money. But just because he made money doesn't make it a good trade, right? We can make money and it could be a bad trade. Conversely, we could lose money and it was actually a really good trade, right? The result is not the determination of whether or not it was a good trade. And if you guys have ever read Andy Duke's book, I forget what the title of it is. It's a very famous book. Oh, Thinking in Bets. Thinking in Bets is her book. She goes into this. I mean, her whole book is about this, right? It's about, focusing on the result, not the process. The process, if you get the process right, yeah, you might not get the result you want, but if you do the process right consistently over time, you're going to outperform everybody. And that's what we were trying to talk Straz out of doing today. Like, look, it might work this time and that's great. But the one time it doesn't work, you're going to give back, the profits on 6 of these types of trades.
Get blown out. Listen,
Yeah.
I'm just caught up in a world of negative feedback loops right now. I think, and you guys are like gaslighting me while I do it too, because for years, just so people know the background, it's like Straz is always long premium. Why are you never selling premium, dude? And then I come around and I'm just loving selling the premium, and Sean's like, no, it's not the time to sell premium. So I'm just so confused here. I'm just like a lost boy out here, just making
Look,
bad.
I love that you're learning all the tools in the toolbox of options trading. This is great. This is
Yeah,
great news.
I have them.
Now, the next thing you need to learn is just, the right environment for the right strategies. You know how to do the strategies, which is great. But there's a time and a place for every strategy
I love it.
that they work better in certain environments. And options, more than any other type of trading, options is a statistical game. It's a numbers game, right? You're playing the odds. You just want to stack the odds in your favor as much as possible. That is a recipe for success in options trading, and
And
you'll
this
get there. You are getting there. So
and
you've
this
come
is
a long
why.
way since you and I started talking options about 3 years ago.
Yeah, and this is why we're so lucky to have you, Sean, on the team, because we have to go back to Sean, and he checks us on stuff like this. It's really nice to have an options expert. I will
All
also
right.
say, hold on, I was thinking about it. The a lot of our disagreement about this too comes down to the simple fact that you're starting with implied vol, because you're making the case right now these trades just don't make sense in certain environments. So I don't even think of them, right? Is basically the
Right.
corner that you're coming from. And I'm coming from a chart first perspective, right? That's why I'm running into I'm looking at some of these charts and I'm saying, I love betting on no further downside, but I don't love upside. And it's selling puts is the logical thing, right? So
Yeah.
I'm chart first, you're vol first. In worlds where those two come together and the chart lines up and the vol is there, oh my God, we're gonna have a party.
Yeah.
Selling vol.
And look, and we've done that like over the past 2 years. I mean, how many times did we sell puts in Oxy? At least 4 times, maybe
Yeah, you're right.
more. And it
Yep.
worked every time. Great. It did exactly what we thought it would. But we were getting paid to do it then. I mean, I don't think we ever sold puts for less than $1 in Oxy. And right now we'd be selling them for like 55 cents. Like, forget it. It's not
Yeah,
enough.
I like this 2% rule. I gotta write that down. Start using this
Yeah.
2% rule.
All right,
All right.
folks. So I think at least the trade I landed on is I like Oxy for all the reasons we discussed. I'm just going to play it differently than we've done in the past. I'm going to buy calls. I'm going to define my risk, give myself the potential for unlimited upside, but I'll probably look to at least sell half of my position if we get up in the 70 to 75 area. I'll look a little deeper into it before I publish my piece on it, but somewhere around there, I'll sell half because that's the resistance that's been resistance for a long time. But I'll keep a little piece in case we get the runner, and then it's off for a great summer.
Giddy up.
All right, folks, this has been the Flow Show. Thanks for tuning in. I'm Sean McLaughlin. He's Steve Straza. We'll do this again next week. Thanks for tuning in. We'll see you on the morning show tomorrow. Bye-bye.
Happy Monday.